Let's talk about a situation where you are basically, you have multiple states for business tax. Where should you file exactly? So here's an overview I want you to pay attention to. First of all, you need to really understand where your company is domiciled. So in other words, you probably have, it's either you have one company or you have multiple companies. So if you have one company, it's really important to really file your taxes in the state where your company is domiciled. So let's say you have an LLC. So you probably file your LLC in one state, let's say New York. So your company is domiciled in New York. So you got to really file tax. You got to file state income taxes in New York for your business, but also for yourself, right? So that's number one. That's if you have one business. Now, if you have multiple businesses, that means that you have to consider filing taxes in all the states where all those companies are domiciled. So this is really important. So we got to look at the state income tax. Now, federally, you can actually consolidate things federally. That's not a problem. In other words, you can either file one Form 1065 or one 1120S or one Form 1120, depending on the kind of a legal structure you have. So federally, you have the option to consolidate things or to file a federal tax return for each state. So you got to really be clear about that. So now, what if you are in the military and stationed outside your home state? Let's say you are in the military and you're stationed outside your home state, but you also have on the side, you have side gigs on the side. And so you are basically running business on passive income, for instance, that the situation doesn't change anyway. It doesn't change. Okay. Now, military personnel designate their home of record as the state where they basically enlisted originally. So generally, military personnel are considered residents of their military homes of record, and federal law prohibits other states from taxing the wages of non-resident military members stationed in their state. So that's kind of cool. So you will not be paying taxes on your military income. And one thing I want to say here is that if the military person takes on a second military job in a town that is different from his or her hometown, those wages are not covered by the federal law. So you got to really follow the civilian rules for filing requirements for those in-town wages, not only for personal taxes, but also for business taxes. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. Now let's talk about a situation where you are in the military and your spouse is not. Well, spouses who are not in the military can claim a state of domicile, just like the military spouse. And so this can be the same home of record as the military spouse or a different one. That's not a problem. Now, the important fact here is that the non-military spouse must actually establish residency in the state that is to be the home of record, whether for himself or herself individually, but also for his or her businesses. Okay, this is really important. Now, what if you are a resident, part-year resident, or a non-resident? How do you actually file your taxes here? Now, there are two things here. First of all, let's address the individual part, and then we'll address the business part. And so you have resident and non-resident. So residency is actually the location of your home where you intend to live when you return from a vacation or a temporary business trip. You are a resident of a state if you intend your main home to be in that state. Let me give you an example. You have a home in North Carolina and live in North Carolina during the year, except when you take a tour, let's say a 4-month or a 5-month vacation in Florida, you file the resident form for North Carolina. Let me give you another example. You moved to North Carolina sometime between January and June and stayed in North Carolina for the remainder of the year, let's say more than 6 months. You filed a resident form for North Carolina. So you are a non-resident of a state if you did not live in that state at any time during the tax year, but you did receive income from that state because you either worked in the state but did not live there. You received income from sources such as business, for instance, rental property within the state, or you received income as a beneficiary of an estate of trust from sources within the state. And the thing I want to say here is that when we talk about the business side of things, now, regardless of where you are based physically and individually, if your business, everything goes back to where the states where your business is domiciled, but also the states where your business is generating revenue. Okay, and so any states where your business is generating revenue, you must file taxes there, and also you also must file taxes where your company or companies are actually domiciled in terms of incorporation. Okay. Now, one thing I want to say also is that it's important to make sure that you actually follow through with state tax authorities, because state taxes are changing all the time, and you want to comply with the current law. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about multiple states for business taxation. Where should you file exactly? Let's talk about how can you tell if your time in the States was permanent or temporary. So here we are speaking about individually, but also business-wise. So the thing here is that you have to decide whether the time you spent in each state was permanent or temporary. You also have to decide whether the business is domiciled in that state, whether there was income that was generated in conjunction, if you will, or in connection with that state. So the answer to all those questions determines which tax forms you need to fill out for each state and how you calculate your state taxes and also your federal taxes. If you made a permanent move from one state to another, not only individually but also business-wise, you are considered a part-year resident of each state. If your work in the other states is temporary and you maintain a permanent residence in the states you left to go to do this work or to conduct business, you may be considered a non-resident of the state, of that other state. And your business will also be considered a business domiciled in another state. In other words, your business will be considered a foreign business. So the most important factor in determining the kind of move you made is your intent. So states want to know, did you intend to make a permanent move? Whatever your intent, you need to back it up by your actions. How much time did you live in the other state? Or how much time did you actually generate revenue from the other states? And did your immediate family move to the new states with you? Okay, and this is also pretty prominent if you have family members who are in the business with you, in the business or businesses with you. So what I want to say here is that proving your move was permanent, so you can show you intend to establish permanent residency in your new state for yourself and for your business by registering to vote in your new state, by registering your car with the DMV in your new state, changing your driver's license to your new state, purchasing property in your new state and moving your household to the new property, applying for any property tax exemption or other special privileges the law allows you because your home in your new state is now your primary residence, sending your children to school in your new state, incorporating in your new state, basically incorporating and also having a state tax ID number, okay? And also you can actually also move your company's, your business's headquarters in the new state. You can also you can also show your intent by moving your primary bank account to your new state, by having your membership in any social or business organizations changed to chapters or groups in your new state. You also have the opportunity to prove that your move was temporary. So the IRS considers your move to be temporary if you are in the new state for work, for business, for anything temporary, and you expect your job or your business in that area to last less than a year. Okay. Caution though, although many states follow the IRS rules about how to decide if your move is permanent or temporary, some states presume that you have made a permanent move if you live there for 6 months or more. So just be aware of the number 6 months or more. So the truth is that it's often easier to become a permanent resident, not only individually, but also business-wise in your new state than it is to stop being a permanent resident in your old states. In most states, even though you are presumed to be a resident after you've lived there for 6 months, you may have to be gone from your old states for 18 months before you were considered by the time test to be a non-resident, okay? So it is often more important to show your intent to live in a state to leave a state than it is to show your intent to become a resident in a new one. And again, I'm speaking here about business, but also individually. So if you end up with both states wanting to claim taxes on your income, but also claim business taxes on your income, your evidence of intent will be crucial. And if you intend for your move to be temporary, avoid doing the things that I just listed for proving permanent resident status, and do the following instead. So you want to vote by mail, in your home state instead of changing your voter registration in the new state. You want to keep your incorporation address in your old state. You also want to make sure that you have a registered agent in your old state. You want to keep the registration for your car in your old state, business-wise, but also individually. But be sure to call your insurer and find out if you need different coverage, because your car will be in the new state for a temporary period of time. You want to keep your driver's license from your old states up to date. You want to live in rented property in your new state and maintain your household in your old state. And this applies also for your business's headquarters, if you will. And if you purchase a house to live in while you are in a new state, do not apply for any special property tax exemption that you would be entitled to if this were your primary resident. If you're only there temporarily, then your primary residence is still in your old state. And this applies also for any house that you buy in the company's name. And don't move your family to the new state. Don't move your family members if they work with you in the company. And open a new bank account in your new state if you need it for your convenience, but keep your main bank account in your old states. This also applies to the business bank accounts. If you belong to certain social or business organizations, check with the chapter, group, or similar organizations in your new state to see if you can have temporary visiting membership rights. The fact that you made an inquiry about membership rights may be a deciding factor if your residency is challenged. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about multiple states for business taxation. Where should you file? There are a few rules for filing income tax, business income tax for multiple states. And we're talking about income tax, not only business, but also individual income tax. Now, we want to talk about creating a nexus. So businesses must file tax returns in a state if they create what tax law calls a nexus, which basically results from conducting qualifying activities in the states. So court cases play a large role in determining which activities establish a nexus. So thresholds can vary among states. So typical qualifying activities include having a physical presence, if you will, in the states, and having employees who regularly work in that state. Okay. And now let's talk about apportioning income between states. State income tax laws typically make adjustments to the federal tax base for simplicity, and businesses that file multiple state income tax returns must apportion their income between the different states in which they file to avoid paying tax on the same income twice. So the formula takes into account factors such as the proportion of payroll, property, and sales in each state. And there are also, in some cases, something called taxable entity issues. So some businesses receive special tax treatment offered by federal laws, such as S corporations and limited liability companies, LLCs. So state tax laws do not always align with federal laws in how they treat such businesses, which can really lead to some issues, right? Let me give you an example. Some states such as New York, you have New Hampshire, Tennessee, and Texas. They tax S corporations as traditional C corporations rather than allowing the business to pass its tax attributes through it to its owners. By the way, New York is not part of it. It's New Hampshire, Tennessee, and Texas. So there are also some owner tax issues. So the owners of companies that do business in multiple states might be hit with some of the increased tax filing burden, especially common with owners of pass-through entities like S corporations. The owner might be responsible for filing a personal income tax return in each state the business established a nexus. Some states simplify this by allowing the company to file a consolidated return on behalf of its owners, while others prohibit consolidated returns. A sole proprietor actually reports his or her business income and expenses on his or her individual return, and he or she has to file an individual return in each state in which his or her business operates. Okay, so this is kind of important to really think about that. One thing I want to say here is that multi-state businesses have choices with pass-through entities and state income taxes. It's important to really understand that you have to think about not only the state standing, but also the tax status. So state laws require that corporations complete scheduled filings to maintain legally active statuses. For example, generally, a corporation must file annual reports with its state of incorporation. A corporation can be reclassified to inactive status if it fails to comply with its state filing laws. Inactive status can also result if a corporation completes a significant change, such as changing its name or merging with another business. And what about tax status? Well, corporations automatically have C status with the Internal Revenue Service when they are created, regardless of the state of incorporation. And corporate shareholders can actually elect S status by filing Form 2553 with the IRS and meeting other IRS requirements. And the S status allows corporate profits to be claimed once on shareholders' personal tax returns, which avoid the double taxation of personal and corporate tax on profits. Okay. Individual states may or may not recognize S corp status for state taxing purposes. So this is really important to really keep that in mind. And so when we talk about that reclassification, it's important to understand that everything revolves around the specific states where you're in. And now the thing is that, as I said earlier before, multi-state businesses have choices with pass-through entities and state income taxes. Everything revolves around what specifically your state is actually asking for. One thing I want to say here is that it's important, again, to go back to what I told you before. It's all about where the business is domiciled. That's number one. And what percentage of sales you generate from each state where the business is located. And this is what I was just telling you about, establishing a nexus, but also having the apportioning of revenue. And so the apportioning of revenue is really important because it really will tell the state tax authorities which portion of your income should actually, quote unquote, sort of go to that state in terms of state income taxes. Now, let's talk about what you need to know about filing taxes in two states, okay? This is a situation where you have two states, but not five, not six, you only have two. Now, filing taxes when you live in two different states, personally, but also for business, it's important to understand that how you file taxes for the two different states you live in will depend on several factors, including which state is considered the source of income. And this applies to you individually, but also to your business. Specific states involved. If you changed jobs or kept the same one, if you hired in the new states or you kept your staff in the old states, if there is a reciprocity agreement between the states involved. And so you will likely file a part year return in both states. Usually you have to file a state return in any states that you have earned income from wages or self-employment or business income. You have property that produces income. You have business that produces income or losses, for that matter. Okay. And it's really important to understand that when it comes to filing taxes for multiple states, when you work across state lines, it's all about making sure that you are compliant. And most importantly, you got to really keep you got to keep the proper records, because if they start asking you, you got to have the ability to know exactly how to prove residency versus non-residency. So when we talk about taxation, also you have to understand that there are tax issues that really arise when we talk about expanding your business in a new state. If you were to change the domicile of the domicile, if you will, of your current company or companies, first of all, you want to find out if the legal name of the corporation, LLC, LP, is available for use in the foreign state. You want to order a certificate of good standing from the domestic state. You want to actually decide who will be the corporation, LLC, LP's registered agent in the new state where you're going. You need to complete the application that has to be filed in order to foreign qualify. And also you need to deliver the application for authority, certificate of good standing, and fees to the filing office. Okay. So those 5 steps need to be followed. Otherwise, you're not going to get the reclassification that you really need. Thank you so much for your attention. I really appreciate it. Let's do a quick recap here. So in today's conversation, I was talking to you about multiple states for business taxation, where to file. So I actually give you an overview, and then the pro tips. I actually also talked about the situation, like various situations where you have to claim income in one state versus another. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.